This is Back Roads of Illinois server to farmers and ranchers in central Illinois and the Midwest on KSIR in Fort Morgan, Colorado. I am Cesar Delgado. This is the Markets Club podcast. We were talking about the fundamentals and technicals on the corn and beans, wheat and technicals. He is joining me now as Bob Manduca from Manduca Trading. This planting progress in Wisconsin and Illinois. It is pretty wet and cool in the Midwest. We were bringing it up with the storage of the old crop for right now, and we were looking for the beans markets with Mike North from Everag. Fertilizer and the weather. Planting progress. We were talking about these topics with Brian Basting from Advanced Trading. This is the Markets Club podcast on Back Roads of Illinois. We were talking about the fundamentals and technicals on the corn and beans, wheat and technicals. He is joining me now as Bob Manduca from Manduca Trading. Hey Bob, how are you? Yes, the Cubs are looking good shape than the opening day.
That is right. Cubs are looking great. I mean, I was there on opening day and it was a cold, cold game. So the weather was unfriendly, and it didn't turn out well for us. But the Cubs really have had a good run this year so far. I mean, a lot of games left, but still, knock on wood. Let's hope they can keep this momentum going. That's for sure.
Welcome to Chicago.
Well, all right. Happy to share some time with you. Talk about the
Bob,
markets.
how are the fundamentals trends in corn markets with these prices? We don't see the break even don't add up for farmers. What is your position on the corn markets?
Well, I would say my main position is I am friendly on the brakes, but mindful of resistance. I'm not necessarily bearish corn, but I'm also not comfortable saying the market has a, let's call it a blank check to just move a lot higher. We still have a lot of growing season to go through, and maybe it'll be given the catalyst. But at this point, we're just going to take it day by day. The farmer break even problem is real. And at today's input structure, there are a number of producers that need better prices than the board is offering. But the market is still looking at a big intended acreage number, trend yield, and good early planting progress. So there's things on both sides of the equation that I think are going to keep the market in balance. So the futures market is not going to pay farmers for high break evens by itself. It needs that catalyst, like I mentioned. And maybe the catalyst could be weather, like I said, as the season evolves, could be stronger export demand, could be a Chinese purchase package that comes out of the Trump Xi meeting, could be continued energy strength if that continues to be a source of, if the conflict continues and things don't abate there in terms of energy prices, or it could be a production issue somewhere else in the world. Now, we did get a WASD number this morning, and I think it makes the corn story a little more supportive, but not necessarily wildly bullish. I mean, the USDA just hours ago when they published the WASD put the 25-26 corn ending stocks at about 2.14 billion bushels, basically in line with the average trade guesstimate and only slightly above the prior estimate. So old crop corn did not necessarily deliver any kind of major shock. But for the 26-27 marketing year, the USDA put the corn ending stocks at about 1.96 billion bushels, which was above the Feb Ag Forum number of 1.83, but still below current old crop stocks. So the bigger supportive point essentially is the world stocks. They put the world ending stocks for 26-27 at about 277.5 million metric tons. And that was way below the average of 290.5 going into the report. So essentially, the U.S. corn balance sheet is comfortable, but the world corn balance sheet looks a little tighter than had been expected. And I think that matters because it means corn is not just trading, Iowa and Illinois weather. It is trading energy, it's trading South America, China, if anything comes to the meeting, fertilizer, freight, and geopolitical risk. So there's many things that are being nuanced into the marketplace and trying to be discounted into the marketplace that we're keeping an eye on. Now, on break evens, I agree with the premise that the numbers do not feel generous. Many farmers are looking at cash rents. They're looking at the cost of fertilizer, fuel, diesel prices being where they're at, the interest rate environment we're in right now, which has been increasing. And then you just get back to the day to day, week to week of family living costs. And really, at the end of the day, what you're seeing on the board does not leave much room. And that is exactly why I think I want to be careful about saying that farmers are eager sellers at these prices. Now, maybe they need to set a hedge to manage risk, but that does not mean the board is giving them a comfortable margin. Futures markets, they do not trade break evens in isolation. They trade supply and demand. USDA is still assuming a very, very large US crop. And on that note, until weather challenges the yield that they had put, which was 183 in today's report, the market has a reason to resist paying much higher prices. So we'll see how that evolves. One bright spot for corn for sure has been the demand side. It is by no means dead. The demand side has been rather robust. Corn exports have been one of the better parts of the balance sheet. We've seen strong commitments and fresh sales to Mexico.
Beef demand is up and the cattle markets is getting around at 370. What is your thoughts on the cattle markets?
Well, generally, I am still friendly the cattle fundamentals. You got to respect these lofty levels. So we're going to have to see continued interest in terms of open interest on the futures board to show the resolve of the traders out there. But also, you need to really respect these levels because a correction could happen at any time. So this is historically a very, very strong market. Cash cattle are high, box beef is high, slaughter is tight, and demand, I think, has been better than many expected. But when markets are this high, I think they become vulnerable to headlines, policy talk, things like imports, and also potentially fund liquidation. So you're right. Cash cattle reached new all-time highs. I think in the South, roughly 256, 260, Northern dressed in the 400s ish, right? And that all points to tight slaughter, stronger beef values, and that firm demand that I mentioned. Fund length. So the funds have been palms in buying, and some Brazil related headlines, tariff rumors that are working against the market a little bit. Beef demand. So anybody who's been watching this market for a while understands that the quantity of head out there just isn't what it used to be, right? Years of drought, higher input costs, cause of liquidation, and that brought us to the numbers that we're at right now. So it's that tight supply, but the consumer has been willing to pay up, surprisingly, right? I mean, one thing I talk about often is relative value. If you can get your protein through, say, let's call fish, or you get protein through pork, maybe there'd be some shifting out of demand, out of beef and into those two examples. And there's also turkeys, for example. But but beef demand has been remarkably resilient. And at some point, I think the high prices are going to ration the demand. But so far, The market has had enough demand to absorb historically expensive beef. So when people talk about cattle around 370s or wherever, right, or box beef near those historical high levels, the key question is going to be whether the consumer keeps up showing up. That is, up to this point, demand has been better than expected. Now, on the supply side of the equation, it is also still supportive. Like I mentioned, slaughter's been running below year ago levels. The cattle inventory situation has not been rebuilt. I mean, there are talks about heifer retention, okay, but that takes time. And we are not necessarily in a fast expansion phase at all. I mean, maybe there's talks about it, maybe there's some that's starting to happen, but really it's not accelerating from what I see. Heavier carcass weights, they're adding some beef back into the pipeline, but they do not fully solve the tight number problem. It's not enough of weight gains to really offset the tight number in terms of the head that are slaughtered. So the risk side, generally speaking, for me, is that the futures market is not just trading fundamentals; it's also trading headlines. There's talk of reducing or eliminating some of the beef import tariffs that can pressure futures, even when cash cattle are strong. So Brazil headlines matter. Talk from the administration, some initial talks about reducing tariffs out of Brazil. That could be a factor we need to keep an eye on, but will it be enough? We've already been down that path, I think, once before. Will it be enough to really add ample enough supply to really take this market off of the highs that we're seeing and really keep it down, at lower levels? I don't know. I mean, I don't think that really happened first time we go around, but we'll see what happens next time. And when managed money is heavily long, obviously you get the big spec funds that are not going to make or take delivery. And if they get some kind of catalyst that makes them hit the exits at the same time, that could create a little more volatility and, push that market down rather quickly. So basically, the cattle market, in my head, fundamentally bullish, but probably prone to corrections. The cash market is telling me supplies are tight. Cash market is telling me demand is strong. Futures market saying prices are high enough that every import headline matters. We'll keep an eye on that, how that evolves, and yeah, I mean, just more of the same, really, with the strong structural nature of the cattle market. Now, this does not mean that you won't see corrections, right? Any market you see some kind of correction, so it's not going to be a one-way street with new highs week on week on week on week. And if you look at the chart, that clearly tells you so. So it's one of those things where if you're a hedger, take advantage of the high prices when it's pushing up towards these high levels. And then if you're a speculator, you just need to really define the risk and plan your trade and trade your plan.
You have some concerns about the consumer budget might have gone to take some leverage with the gas prices really quick.
Yes, there's 150% concern, right? I mean, how much can the consumers bear? You're going to ask them to pay up for their beef. Simultaneously, you're going to be asking them to pay up for the gas they put in their cars. And simultaneously, with the tick higher in interest rates, you're going to ask them to pay up for, if there's any kind of flexibility in the type of revolving loans that they may have, they might have to pay up there. So yeah, there seems to be a, a growing stew of ingredients that I think are concerning, to say the least. And it's a matter of what's going to give first. Clearly, I think that you can't not put gas in your car because you need to get to and from work, for example, but you can choose not to buy beef. So I think that some of these, they'll call them, these consumer goods like beef and hogs even, um, are going to be more vulnerable than other things that you really, really need and you can't skimp on, such as, like I said, gas prices, putting gas in your tank. So yeah, it's a concern. There's no doubt about it. Hopefully things get resolved rather soon in terms of some of the things that have been the catalyst for these moves that we've seen in interest rates and energy prices and Obviously, the way they've worked their way into the beef prices and such. But yeah, it's definitely a concern. It's going to take some time to work away from it.
Thanks, Bob. Do you have some final thoughts on that? Would you be willing to talk about these grains prices with the fundamentals from the world events?
Sure. Final thoughts. Just I would say you need to make sure that if you're a producer, your number one thing is protecting your price. If you're a producer, your number one thing is protecting the price you can get. Once the board gets to a level that you can lock in some kind of margin, you need to have a plan to execute that. Number one, you always got to be protecting yourself because that's your bottom line and that's your business. For the speculators out there, completely different story. It's all about timing. And I know there's a million different ways to look at the markets and come up with some kind of conclusion on whether or not the next move should be higher or lower. We'll see how. I mean, typically that's a much tougher game because you're not doing it for business. You're just doing it to time the market. But, with the volatility that we've seen, perhaps you have some kind of methodology that can, hopefully add to your bottom line. We'll put it that way. But yeah, there's plenty of things going on right now. I would say try not to get overwhelmed by them. Take them one by one. Don't forget that the price.
Fertilizer and the weather, planting progress. We were talking about these topics with Brian Basting from Advanced Trading. Hey Brian, how are things in Central Illinois?
Hey, Caesar. Thanks for having me. Well, we've seen some better planting conditions here in Central Illinois lately. It's been a bit cool still, but it's dried out, and I think producers around here have really planted corn more aggressively now. They were a little hesitant to plant corn up until now. A lot of the beans were planted in April, but much more corn planting lately.
Good to hear that, but the weather has been wet.
It has been. I think that our soil also, in many ways, is beneficial. Obviously, we have some terrific soil here in Central Illinois, but when it does get wet, it stays wet for a little while. And so that slowed things down. I think the cool temperatures, especially, have slowed corn planting, but it's almost the middle of May now, and I think that the weather is supposed to warm up significantly here short term. So I think with that in mind, producers have turned actively to corn.
Brian, fertilizer and chemical inputs cost is very high due to the war. And don't forget about the pandemic. What is your thoughts? Could we see some break even is not working anymore for farmers?
That's a great question, Caesar. I think for this 2026 growing season, um, a fairly high percentage, not everyone, but a fairly high percentage of producers had already locked in their input costs. Uh, let's say in during calendar year 2025, for example, or regardless ahead of prior to the recent sharp increase in fertilizer and chemical prices here in 2026. So I think we'll see some impact on overall acreage for 2026. I think we could see acreage decline from what the corn acreage declined from what the USDA said back in March. I think a greater impact potentially, though, Caesar, is for 2027 production. Now, a lot can certainly change. We certainly hope that the war is over by that time, and we've seen a reduction in these prices. But at these levels, and looking at deferred prices for 2027 corn, no, it's not a real good outlook for 2027 at this point. But we'll hopefully have a better outlook here as we move into the summer and fall. That producers can go ahead and start locking in those needs.
Corn is king again because of the acreage report. And farming is pretty break-even industry. We mentioned before on fertilizer prices and availability for the financial aid anymore. What is your position on substantial farm supply for the future or the farm economy?
I think it's going to be closely tied to the timing of number one, hopefully the end of the war in the Middle East. If that were to end in the next 2 to 3 months, I think hopefully that prices for 2027 inputs on corn especially will decline later this year, and that would make things much better from a balance sheet standpoint. It's a matter of timing. The farm economy going forward, Caesar, a lot of variables there. We'll be waiting to see what type of farm agreement that the excuse me, the president may or may not have with China this week at the summit. That's another variable to keep in mind. But in terms of strictly looking at the balance sheet as is today, there's some challenges. So I think we have to remain optimistic and hopeful that we can see these input prices back off as we move into the later part of this year.
What is your position on the corn acreage for this June?
All else considered, in terms of the weather here short term, even if we were to see some good planting conditions the next 2 to 3 weeks, I think we're going to see steady to lower acreage in the June 30th acreage report for corn compared to what we saw back in March. Simply because when that survey was taken, the first 2 weeks in March, we did not see, it was just the start of the war, started at the end of February there. We did not see the magnitude of the increase in fertilizer chemical costs that we eventually have seen. Excuse me. But we have seen, as I mentioned earlier, producers did get some of those costs locked in last fall. So I don't want to give the impression that all producers were caught having to pay higher prices for fertilizer this year. That's not true, but some did. And I think that's going to keep the acreage from increasing and potentially being lower in the June report.
Of course. Corn is king. I hate to say that the grains markets are challenging to farmers and the cash grains is in the wise crack, but it's pretty shows that the grain sector. How do we have some certainly in the grains, Brian?
What I'd encourage your listeners to consider, Caesar, is that there are many things in producing crops, corn, soybeans, and livestock too, that are out of our control. Obviously, with crop production, we can't control the weather. And in this case, we can't control the geopolitical circumstances that have arisen here the last 2 to 3 months. What we can do is focus on the things we can control, and that is our marketing. And we can use the tools that are available to us to manage price movement. And we certainly have seen a lot of price movement here, Caesar, in both corn and soybeans the last couple of months, generally to the upside. And we can manage that price movement using the tools available to us, whether that includes options, whether it includes forward pricing, whatever the tool that is your preference. Those are the things we can control. But you have to acknowledge in farm production, obviously, there are many things that are out of our control this year, especially out of our control. So I think you just have to reach a point of acceptance of that. And in particular, this year, Caesar, if you were able to lock down your input costs let's say in the calendar year 2025, prior to the steep increase, that leaves you in a better position for managing these 2026 returns, because obviously you aren't confronted with those higher prices that are present with us today. And we're higher prices for fertilizer and seed, but chemicals. But we are blessed from the standpoint we've seen a modest rally in corn and soybean prices. Soybeans even a bit stronger than corn the last 2 or 3 months here. And that's something that we can take advantage of. And again, be flexible in your marketing, keep a flow underneath the market, keep the upside open. But all of us have to acknowledge, Caesar, that there's only so many things we can control in ag production. This year, there seems to be more things.
Do you have some final thoughts on that? Would you be willing to talk about these grains prices with the fundamentals from the world events?
I just think that you want to remain flexible on your marketing, Caesar. What I'd encourage your listeners to do, if they have any remaining 2025 old crop inventory, to get a flow underneath that inventory. By that I mean either price it or uh, purchase a put option to provide downside protection. But I'd encourage your listeners also to have some upside opportunity. If they were to price that grain, they could purchase a call option to enable them to participate in rallies. Or if they buy a put option, that still leaves an opportunity to participate in upside price opportunities. And then turn their attention to 2026. Manage price movement, Caesar. Avoid price prediction, but remain as flexible as possible.
Of course. Of course. It's pretty tricky overall about the commodities.
It's always a challenge, Caesar. I think the best we can do is use the tools that are available to us to manage these price movements and really avoid price prediction, because that can get you in a lot of trouble. Last year, for example, the market peaked, Caesar, as you know, in February. We never did see a spring summer rally. This year so far, a much different picture. We don't know what the next 3 or 6 months are going to hold, but every year is different.
Thanks, Brian. I enjoyed. Thanks to Bob Manduca from Manduca Trading. This planting progress in Wisconsin and Illinois. It is pretty wet and cool in the Midwest. We were bringing it up with the storage of the old crop for right now, and we were looking for the beans markets with Mike North from Everag. Hey Mike, let's take a look for the beans markets for this week. What is your thoughts with this beans market?
Well, corn and soybeans both up today as we follow the USDA supply and demand report that came out at 11 o'clock. Soybeans right now up 13 in the old crop, while new crop is up a dime. That continues this ongoing rally that has led us forward through the entire month of April and into this first 12 days of May. Soybeans today, as we approach the close, north of $12 on the November contract, which, as we go back and take a look at it, that's the highest close that we've seen since back in March, when the March contract got there right at its finish. And this, carrying some borrowed strength on a soybean oil market that's trading around 75 cents and a soybean meal market that's gone up $30 over the course of the last month as well. So, when we talk about the soybean market, very well supported. Funds have been continuing to buy up and have moved into record long positions in products near record long in soybeans. Very, very well supported, but that also puts us in a place that becomes very vulnerable as well.
How about the technical aspects on soybean futures for this week in Beijing?
Well, as we take a look at the conversations coming up at the close of the week in the summit taking place between President Trump and President Xi, um, certainly there is a lot of hope for additional purchases by China. And certainly, we hope that we can get something out of it. But I would say as you look at the different components of that discussion, we're in a war with Iran. China has seen dramatic price pressure on its imported energy products coming out of the Straits of Hormuz. About 80% of what leaves that region finds its way into Southeast Asia, and China, one of the biggest buyers. That said, if they want to play the blame game, it wouldn't be hard for China to say, hey, U.S., you want us to buy soybeans, and oh, by the way, you're causing us to have to pay more for energy. I don't think so. There's room for that game to get played because remember, this is politics. It doesn't have to be absolute, doesn't have to be right, doesn't have to be real. It often is led by perception and what they can gain from the conversation. And so as you look at the setup for that, it's going to be a pretty tall order for them to, come to the table in agreement to buy more beans. We still have the hope that they can do it, but I think it's a bit of a long shot, so to speak, especially when we consider that, we've watched China continue to make big investment in South America and, functionally put themselves in a place where Brazil is going to be, their favorite source. So, hopeful, I think, is the word as we, look at the outcome of the discussion. Doubtful, I think, is kind of where we sit from a probability standpoint. And if that in fact is the case, watch for big price pressure to come back into this soybean market, which, as I pointed out, has gotten bought up by the funds and has gotten, from a technical perspective, overbought by way of many different technical indicators.
What is your concern about supply of fertilizer for right now with these prices? I've been talking with everyone about it because they are concerned over it.
I think you have to be concerned. Reality is that this time of the year, producers buy very little new quantities of fertilizer, and the needs that we are going to have coming through the growing season are already inside of our own borders. So there's not going to be a lot of what I'll call dire straits produced by the current situation. Now, fast forward into fall. As we get into October and folks start making decisions and purchases concerning next year's crop, that's where this concern grows to something greater. And so as you look at the current landscape, we're all concerned, but I think as we quantify what this means for the current crop year, for yield potential, for expenses, I don't know that there's going to be a lot of immediate outcome from that concern. Again, get to fall, start talking about the 27 crop, that changes everything. As we start, considering 2027, that's when this concern becomes a bigger deal.
What is your thoughts on the June acreage report for the fertilizer space?
Well, I know there's a lot of chatter about high price inputs forcing corn acres into soybeans. Anecdotally, we are not getting a lot of that confirmed by clients. And part of it has to do with the fact that the price of corn has gone up as the price of inputs have gone up. And as far as inputs are concerned, most of them were already bought last fall. The vast majority of them were already secured and even paid for last fall. And so when we talk about how that has impacted acreage, we don't believe that there's going to be this massive migration away from soybeans towards corn, because as we've walked this forward, we're still in a place where, from a what we'll call soybean to corn ratio, we're still looking at a corn to soybean ratio of 2.4. That is just below that 2.5 number that we often assume to be equilibrium and a point of balance between corn and soybeans. Puts a little bit of favor towards corn, but again, because corn prices rose with those input costs, we're staring at $5 on the board. And as we consider a $5 board, we can start to talk about a little added profitability, especially if we feel good about our yields. And, as we consider the drought map moving away from intensely red in certain areas to lighter shades by way of some of the storms that have come through the Midwest of late, as we, talk about, other inputs that have already been secured at lower prices and still, planning to give the crop the nutrients that it needs, provided we have a decent growing season, that means we're going to be producing a fair amount of corn. And if I'm confident in my ability to produce corn, I'm going to grow corn, especially when I've got a market that's going to show me some profitability. And given where costs of productions are, that profitability has been made a lot more certain as we have moved up towards $5 on the futures board.
How are things in W? Thanks to Bob Manduca. How are things in WIT for right now?
Give that to me one more time, Caesar. I didn't understand that.
The cattle markets is getting trickier up with deferred contract on demand. What is your takes on the cattle markets?
Well, kind of on the heels of what I was just talking about, so far the consumer has been, still pretty invested in the beef space, and that's allowed the market to stay relatively high. And as we look to fall, you see pricing at 233, while the front end of this market is hanging up at 247. And, that speaks to the amount of demand that we've had. However, the headline you speak of is one where the White House is back to where we were last fall, asking the question, what are we going to do about high beef prices? And, right now, the topic of the day is opening up the quotas and allowing more beef to come in through the tariff system than what we had allowed prior. Bottom line is that starts to ask who has the capacity to put more into the United States. Places like Australia and New Zealand have some capacity, maybe some limited additional capacity coming out of Brazil and the rest of South America. But it's not going to be a flood, which is what I think most people fear. I think a lot of people think, if we open up tariff rate quota and make more opportunity for beef to flow in, that we're going to get buried in it. Not so much the case. Could it grow? Yes. And I think that's why you see futures down, but not limit down in today's market as we evaluate that particular headline. All the way around, I think we can all accept the fact that record prices, like any other market, adhere to that old principle that high prices are the cure for high prices. And so things shift and change when you're in record territory, and some of these headlines are just right in step with what you'd expect in a market like this.
How is the cash cattle market for right now in North?
Still showing great signs of strength. And I think, as you look at the time of the year that we're in, as we, are getting rain across the Midwest and there's spring grass popping up, and beef prices, continuing to show us great numbers. The demand has been strong, and cash markets have been holding a premium. We expect that to remain the case at least for the short term.
What is your final thought on this beans markets?
Well, for all of my career, I've made a point of highlighting some of the basics. And that is when a market goes up, you have to take advantage of it. So my thoughts around beans are such that producers really need to be taking advantage of what we're seeing here. This market is not one to generally, hang out in this type of environment at high levels with the kind of world balance sheets that we have. Even this morning, as we came out with the May supply and demand estimates, which is a look forward on the 26-27 marketing year, we're still left with just, a few million bushels less than where we were last year. And that same balance sheet is what led us, down to the depths that we saw earlier this year. Reality is that if we get any sort of negative news or lack of news coming out of this Chinese meeting, that could all fold up on itself within days. So these opportunities are worth taking advantage of. Get out there, market accordingly, and make sure you're defending these opportunities that literally didn't exist 90 days ago. So let's be proactive instead of reactive and take advantage of $12 beans.
Thanks, Bob Manduca and Mike North. Brian Basting from Advanced Trading on. Thanks to you guys. I enjoyed our conversation for today.
It was a pleasure joining you, Caesar. Have a wonderful day.
Thanks, Bob Manduca and Mike North. Brian Basting from Advanced Trading on the Markets Club podcast. I'm Cesar Delgado. You have a good day.